Good morning and welcome to Hudson Valley Pattern for Progress's session with Daleep Singh from the Federal Reserve Bank of New York. I am Jonathan Drapkin, the President and CEO, and joining me on the panel is Pattern's Senior Vice President for Research and Development, Joe Chaika. We're going to go about 40 minutes, and after I introduce Daleep, Mr. Singh will give a presentation, and then Joe and I will do some questions with him, and we hope you enjoy the presentation. Daleep Singh is Executive Vice President and Head of the Markets Group at the Federal Reserve Bank of New York. In this role, he oversees the group's full portfolio. He plays a key role in developing and implementing the bank's strategic direction and priorities, and is a member of the bank's executive committee. Prior to joining the New York Fed, Mr. Singh was senior partner and chief economist at the global investment firm SPX Capital from 2017 to 2019. Before that, he worked at the U.S. Department of the Treasury from 2011 to 2017, serving as acting assistant secretary for financial markets and deputy assistant secretary for international affairs, helping to shape the Treasury Department's crisis response to the Ukraine, Russia, Greece, and Puerto Rico. Mr. Singh also directed the Treasury Department's Markets Room, which provided real-time and thematic analysis for senior officials. Prior to his tenure at the Treasury Department, Mr. Singh worked for Goldman Sachs with a focus on U.S. interest rates and currency markets from 2003 to 2007, and again from 2008 to 2011. So unfortunately, Mr. Singh was very much involved during the Great Recession. Mr. Singh is a former adjunct senior fellow at the Center for New American Security and the Atlantic Council. He was also an adjunct professor of geoeconomics at Johns Hopkins School of Advanced International Studies. Mr. Singh holds a bachelor's degree with Duke University in economics and public policy. He also holds a master of business administration and public administration from MIT and Harvard with a focus on international economics. So you can see why we were very pleased to have Mr. Singh with us this morning. So let me start with the first question that I always ask all of our guests when we're doing our sessions. And so Daleep, where were you and when did you know that things were going sideways and that the country was heading for the economic pandemic problems that we have today?
Well, good morning, everybody. Thank you, Jonathan. Thanks to the Hudson Valley Pattern for Progress for organizing this discussion. You know, I started at the New York Fed in mid-February, so this was essentially my onboarding process. I knew pretty quickly. For the last 20 years, every morning I look at a series of numbers, and that's how I interpret the world and how it's changed from one day to another. And, I began to see that in the very core of financial markets and treasuries, things were not functioning well. And, not long after that, we saw a seizing up of every financial market that I observe on that screen. And then we began to see the real effects to the economy and households and businesses. So, I had just moved up to New York and I saw Lower Manhattan empty out. I could barely get takeout. And within a couple of weeks, I began working remotely. So it hit me pretty fast.
Well, I guess as they say, welcome to the job. I mean, that must have been something. All right, so let me turn it over to you. I believe you have a presentation for us this morning. So the floor is yours.
All right, thanks again, Jonathan, and thanks to everybody for being here. During his regional visit last July, my boss, New York Fed President John Williams, heard from you, Jonathan, others in the area about a number of issues, workforce development, changing demographics, concerns about equitable growth, and lack of affordable housing. I have no doubt all of these issues have become much more acute and many deeper ones have arisen because of the tremendous hardship caused by the pandemic. So now more than ever, dialogues like this one give us a lot of insight into the extraordinary challenges faced by the communities that we serve. So with that as the context, I'm going to spend the next 15 to 20 minutes reviewing the actions the Fed has taken to support the US economy in the face of the pandemic, with a particular focus on the facilities that were created under the Fed's Emergency Lending Authority. I'll explain the effectiveness of these facilities, I'll offer some early lessons learned, and then I'll end by highlighting some of the challenges as we look ahead. And let me emphasize throughout this discussion, many of the tools I'll discuss work through financial markets, they work through large institutions, but the end goal is to achieve maximum employment and stable prices and to make a difference in people's lives. And so I'll also speak about the new lengths the Fed has taken to support an inclusive recovery. I should also say at the outset that the views I express are my own and do not necessarily reflect those of the Federal Reserve Bank of New York or the Federal Reserve System. Okay, so the Fed's unprecedented actions. As part of a comprehensive government response, the Fed has taken unprecedented action in pursuit of its dual mandate to promote maximum employment and stable prices. Chair Powell recently bucketed the Fed's actions across 4 areas. First, open market operations to restore market functioning. Second, actions to improve liquidity conditions in short-term funding markets. Third, programs launched in coordination with the Treasury Department to facilitate the flow of credit to households, businesses, and state and local governments. And fourth, measures to encourage banks to use their substantial capital and liquidity buffers to support the economy during this time of hardship. The Fed has also made a number of regulatory adjustments to help address the crisis. So while the Fed has faced many crises in the past, what's truly distinguished the current situation is both the speed and scale of the economic and market deterioration brought on by the virus, as well as the speed and scale of the policy response. Over a 3-week period in March and April, the Fed ramped up its use of existing tools to an historic degree, and in coordination with Treasury, invoked its emergency lending authority to launch 9 new facilities to support a broad cross-section of the economy, all with the intent of supporting economic activity and employment. At the same time, robust fiscal support was deployed to provide direct relief for those suffering the consequences of the virus. Now, policymakers have made very forceful commitments to these facilities. They have a combined capacity of more than 2.6 trillion. That's easily several times larger than the peak facility usage in the global financial crisis. And although the challenges of 2008 and 2009 were very different than the current shock, that experience left us blueprints for tools that could be used again, and it encouraged us to act creatively and forcefully in deploying new tools that are better suited for the current circumstances. In doing so, the objective from the Fed was to prevent the immense panic-induced declines in economic activity from morphing into a full-fledged financial crisis or producing long-lasting scars for households or businesses. Let me turn now to the usage of the facilities. 4 months in, all of the emergency credit and liquidity facilities are operational, and we can begin to take stock of how they're being used and the impact they're having. Let me just say the bottom line. The impact has been large and sustained, even while the usage has been generally low. So let's turn to Figure 1, which shows the outstanding balance of loans or asset purchases for each facility as of July 1, and also the peak outstanding balances since each program was launched. You'll see that the peaks in 2020 are well below those seen for similar programs deployed during the global financial crisis. And the limited usage to date compared to 08-09 can be explained in part by the fact that the core of the financial system was in much better condition entering into this episode. Banks themselves were well capitalized, for example. And because the crisis didn't originate in the financial sector, markets were able to recover faster from the initial shock and have been highly responsive to the combined fiscal and monetary policy response. For their part, the backstops established by the emergency facilities have proven especially powerful in restoring confidence for private sector borrowing and lending to resume, which in turn helps the flow of credit to the economy. Now you can see the resilience of financial markets. It's consistent with the trends in Figure 2, which shows how facility usage has evolved over time. The first facilities to start operations were the primary dealer credit facility, PDCF is what I'll call it, the money market liquidity facility, the MMLF, and the commercial paper funding facility, CPFF. These are the light blue, dark blue, and red areas respectively in the chart. Now these programs sought to repair short-term wholesale funding markets, which are essentially the lifeblood of functioning markets. As those markets recovered with support from the Fed's actions, the usage of the PDCF and the MMLF have declined. And similarly, with an easing of pressures in commercial paper markets soon after the announcement of the CPFF, this facility too has seen only limited take-up. Now, these patterns reflect the lender of last resort design of these programs. They provide a relief valve if market strains re-intensify, but they're not expected to be used heavily under less stressful conditions. Now you'll see the main source of growth in outstanding balances comes from the Paycheck Protection Program liquidity facility. And this is shown in the dark gray area. The purpose of this program is to bolster the effectiveness of the Small Business Administration's PPP program. And it does that by supplying liquidity to banks and non-bank financial institutions that originate PPP loans. So since its launch in mid-April, PPP LF usage has risen steadily, and the outstanding advances are now about $70 billion. Now, this amount is still well below the PPP program itself, which is around $500 billion. But nonetheless, we've heard from PPP lenders that the PPP LF bolsters their confidence to make PPP loans to small businesses, as every PPP lender is eligible to use the PPP liquidity facility. At this point, well over 600 PPP lenders are currently using the facility across all 12 reserve banks. Now, elsewhere, we've seen modest starts to several other facilities that recently launched and stand ready to support critical segments of the economy. The gold area is the municipal liquidity facility, which funded $1.2 billion of 12-month notes for the state of Illinois to assist with COVID-related cash flow pressures. Not visible here is the term asset-backed securities loan facility, or TALF. And this facility is designed to improve lending conditions for a range of consumer, small business, and commercial loans. TALF launched last month, and it's lent about $250 million to date. Additionally, we have lending facilities that are now available to help businesses maintain operations and to keep employees in their jobs. The Main Street Lending Program, which provides loans to small and mid-sized entities, including nonprofits, and the Primary Market Corporate Credit Facility, which provides bridge financing to larger investment-grade corporate employers if they can't secure credit elsewhere, both recently opened. Now, more sizable, you see the pink sliver, and this shows balances of corporate debt the Fed has purchased through its secondary market corporate credit facility, about $10 billion so far. Unlike the other facilities, which created standing windows for eligible borrowers, the Fed sets the pace of corporate debt purchases based on market conditions. So since the SMCCF's launch, as market functioning has improved, we've slowed the pace of purchases from about 300 million per day at the outset of the facility to a bit under 200 a day currently. If market conditions continue to improve, Fed purchases could slow further, potentially reaching very low levels or stopping entirely. This would not be a signal that the SMCCF's doors were closed, but rather that markets are functioning well. Should conditions deteriorate, purchases would increase. Let me turn now to the impact of the facilities. And I'll reiterate the point from earlier that despite the low usage of the facilities, their impact has been large and it's been sustained. First, in terms of liquidity and funding conditions, we've seen a dramatic recovery since mid-March, and you see this in Figure 3. This improvement likely comes from a full array of policy actions that were deployed in very quick succession. Not only the facilities I just mentioned, but also the lowering of the Fed's policy rate to effectively zero, extended repos and purchases of treasuries and mortgage-backed securities, more generous terms for discount window borrowing, and an expansion in the availability of cross-border liquidity. Now, turning to credit conditions as seen in Figure 4, we've also seen a sharp reduction of credit spreads that's broadened over time from investment-grade debt to high yield to municipal bonds and asset-backed securities. And this has triggered a surge of issuance across asset classes as borrowing rates have normalized. While there are still pockets of strain in some markets and in sectors where business models are directly challenged by the virus, even in these areas, there are tentative signs of healing. Okay, so with the usage and the impact in mind, let's talk about some early lessons learned. Now, of course, there are limits on what the central bank can do, and only time will tell the ultimate impact of the facilities on supporting the Fed's dual mandate. But I would attribute the facility's initial success to four main factors: their size and scope, coordination across the government, their flexibility, and their sustainability. So let's talk through those. First, the size and scope of the facilities. They've demonstrated the Fed's capacity and its resolve to blunt the initial economic effects of the pandemic. As I mentioned earlier, the potential lending capacity of the facilities is unparalleled, and critically, this lending capacity is being channeled to a broad cross-section of financial markets and the economy. It's supporting the availability of credit for households. It's helping small and medium-sized businesses maintain their payrolls and their employees through new and expanded loans. It's providing credit to large employers so they're able to pay suppliers and maintain business operations. And it's supporting state and local governments experiencing cash flow pressures. Second, the facilities represent a full partnership with the Treasury Department, and this signals a government-wide effort to cushion the U.S. economy from the shocks caused by the pandemic. The Treasury Secretary approved the Fed's use of emergency lending authority under Section 13.3 of the Federal Reserve Act to establish these programs, and the Treasury has provided equity investments in many of them, thus absorbing some of the risk of the Fed's involvement in private credit markets. The close alignment of the Fed and Treasury served as a force multiplier in transmitting stimulus, especially at a time when investors, businesses, and the public at large were looking for signs of a coordinated government response. Third, the facilities are flexible. Term sheets for each facility have been updated or amended since they were first announced, demonstrating a willingness to adapt program design in response to feedback and in response to changing conditions, and in order to make the facilities more accessible and inclusive. As Fed policymakers have made clear, these programs can be ramped up and they can be refined further as needed, depending on the impact of and the lessons learned from the initial rollout. Lastly, a key success factor has been the sustainability of the facilities. Although the Fed has moved to implement the facilities at maximum speed, we've also done so with maximum care. This means our efforts to launch and operate the facilities are guided by a set of principles that we believe will sustain the public's trust and confidence in our actions. Transparency, inclusive access, good governance, and accountability are at the forefront of our work to implement the facilities. And let me expand on each of these principles. Transparency. Transparency is fundamental to our credibility. We know that the Fed, together with the Treasury, have been entrusted to deploy large sums of public resources. And in practice, this requires that we make clear in our term sheets and our public FAQs who's eligible to participate in the facilities, as a borrower, as a seller, as an intermediary. It means timely reporting on the facilities in terms of who's using them, including and going beyond what's required by law. It means making public all vendor contracts, including details on the fee structures and the key terms of our service agreements. Let's talk about access. In an effort to contain the damage from the virus shock, the Fed retained several outside vendors to accelerate the facilities rollout and to supplement our areas of internal expertise. Our initial vendor selection prioritized expertise, scale, and in many cases, the ability to segregate a team of dedicated personnel. We also relied in many cases on existing relationships with primary dealers as financial intermediaries to get up and running quickly. Now, this approach helped us to launch our facilities at maximum speed, but our strategy from the start has been to diversify our vendor and counterparty base in the post-launch phase. All of the contracts the New York Fed has signed are short-term. Each has a provision to cancel with 30 days notice. And given this flexibility, we're evaluating all contracts after 90 days with a priority on rebidding those that were not competitively bid. We're also actively exploring opportunities to diversify the range of potential vendors and counterparts that we work with across the facility's activities. Now, finally, in pursuing our policy goals, we have an obligation to the public to be accountable for all of our actions. So we've embedded the facilities into reserve bank risk management and control frameworks while building new layers of governance as added layers of protection. We also remain ready to engage with our oversight bodies and those appointed under the CARES Act to ensure that the American people understand the steps we're taking on their behalf as faithful stewards of the public trust. Now, in my remaining time, let me just mention a few of the ongoing challenges and opportunities as we look ahead. First, as President Williams said just last week, the virus has hit the most vulnerable segments of our society the hardest. Communities of color and lower wage workers are facing higher rates of unemployment, limited access to health care, and greater exposure to the virus. We need to stay focused on the distributional effects of our actions and challenge ourselves to promote a more equitable recovery, while also understanding the limits of what our monetary policy and lending powers can directly achieve. Second, while we can be confident that low facility usage amid generally well-functioning markets reflects the power of backstops, we must remain vigilant for any signs of hesitation of eligible participants to use the facilities out of concerns it sends a signal of weakness. Credible backstops provide confidence that may prevent a severe deterioration of market conditions going forward, but the true test of the facility's effectiveness will be if they are used when needed in dysfunctional market conditions. As always, we stand ready to make adjustments to our operations as necessary to meet our objectives. Third, what does the intensity of market distress and the abrupt deleveraging in mid-March tell us about the vulnerabilities that we're building in the non-banking sector for many years, particularly for business models that are structured with large amounts of embedded leverage and those that are still reliant on short-term wholesale funding? And finally, while we entered this crisis with well-capitalized banks, we need to be watchful of banking sector resilience in the face of potential waves of non-performing loans and bankruptcies that could challenge asset quality. All of this is to remind us what we already know. There remains tremendous uncertainty about the path ahead. And so we must remain humble in the face of ongoing risks and resolute in our commitment to adapt as needed. I'll conclude by expressing my deep personal gratitude to the healthcare professionals and essential workers who put themselves at risk each day to meet the basic needs of others, and to my colleagues at the Federal Reserve who continue to work tirelessly to help safeguard our economy and our financial system. I'm humbled and inspired by their service. Thank you.
Thank you, Daleep. That was actually wonderful as a description, but in an absolutely traumatic period in our nation. You know, I've been trying to think of how do you describe everything that you were doing for the, for the common guy that's just walking on the street, why the Fed and the Treasury Department are so important. And I was looking at it, and I was, looking at your presentation and trying to think about it in terms of, it's almost like you're the brakeman on a train. And either you're like letting the train go forward at the speed you need it to, or you're slowing it down, or you're helping it. Because for most people, they never see you. They never see the Fed, they never see the Treasury. And yet it is the critical tool in helping to get this economy up and going again. And obviously, for those that do follow it, all the bankers on the call and everything, you're absolutely critical at this stage. If the healthcare workers were the frontline workers as the virus was out of control in New York, then your actions now are coming in. You're the next bad analogy. You're the next wave of trying to say, well, how do we fix now the economy if we can control it? And so we appreciate everything that the Fed has been doing, that you've been doing, people in Treasury. So, Joe, do you want to start us?
Sure. As you know, Daleep, Pattern focuses on community and economic development, housing, affordable housing. So I wanted to switch gears a little bit and talk about that. Which of the Fed's most recent actions in response to COVID will be the most impactful for businesses and for the lives of individuals in the Hudson Valley?
Yeah, thanks, Joe. And I don't want to sound glib, but I think all of the actions are directly relevant to people in the Hudson Valley. Sometimes I think there are false distinctions made between which of the Fed's actions help Main Street versus Wall Street, but they all have the same purpose, which is to get people back to work and to get the economy moving again. Now it's true, they work in different ways, and that's because we have a sophisticated economy and a complex financial system. So we provide support through a lot of different channels. So let me talk for a minute about some of the earliest facilities that we announced, and I referenced these in the presentation. The commercial paper facility, the primary dealer credit facility, the money market liquidity facility, they all sound quite esoteric, but what they do is they breathe oxygen into markets that were seizing up in March. And this matters because millions of people park their savings in money markets, and thousands of businesses, and many of them in the Hudson Valley region, they finance their payrolls, their operations, their inventories by borrowing in these markets. So it matters. Another action that not everyone understands is why our asset purchases are impactful. So just to be clear, again, back in mid-March, the cost of transacting in US Treasuries went up by a multiple of something around 13. And so that meant that the very core of US financial markets, and therefore the core of the US financial system, was no longer functioning. Now, who cares? Well, Treasuries directly fund the US government. They provide the basis for pricing every loan that's taken out by households, businesses, state governments, local governments. They determine the degree to which savings vehicles across the world are still safe, and they're the foundation for the dollar's role as the world's primary reserve currency. So without liquidity in US Treasuries, we wouldn't have stability in the US economy, and the job losses and economic pain would have been much more severe. Now, if we talk about, Joe, the credit facilities that the Fed and the Treasury have stood up, the effects are more direct, and I can connect some of the dots for you. So that the TALF, for example, what is the purpose? Well, it's designed to repair markets that finance a number of consumer loans and small business loans, so student loans, auto loans, commercial mortgages. The PPP lending facility, I mentioned that one as well. That provides cheap term financing for banks and non-banks that are giving out PPP loans to the almost 5 million small businesses that have borrowed from it so far. The primary corporate credit facility, now that is meant for larger, healthy corporate employers who need bridge financing and are willing to pay penalty pricing. But what is the purpose of that? That's to help these large employers keep people on their job and to rehire when we get through the shock. Mm-hmm. The secondary market facility plays a complementary role. It purchases corporate debt to improve issuance conditions. But as the secondary market improves, our purchases have slowed. And as I mentioned, we could stop those purchases entirely if the market returns to normal. I'll just say I'll mention one more facility and then I'll stop. So sitting between the corporate credit facilities and the PPP program is the Main Street facility. And this one is intended to help small and mid-sized businesses that were in good financial standing before the shock, but they might be too large to qualify for the PPP program and maybe too small to get access to financing through bond markets. And so we're trying to make sure they don't get left behind. And so that's the purpose of Main Street, and we've sought feedback to expand it further to include loans to small and mid-sized nonprofits, which would include hospitals and universities. So, I admit sometimes loans aren't what's needed in a shock like this. Sometimes households and businesses can't afford to take on more loans. So, monetary policy isn't the only solution. Fiscal policy has a critical role to play in replacing a lot of that lost income and lost earnings. But monetary policy certainly has a role to play, and we're trying to use it to the full extent possible. And really, all of these programs I mentioned, they work in tandem, and they have the same purpose, which is to make a difference in people's lives and to help them get through the shock.
Sure. And here in the Hudson Valley, we certainly see that working. There's plenty of businesses that are taking on these loans and keeping their doors open, thankfully. Jonathan, did you want to move on to the next?
Yep. There's a huge relationship between the Hudson Valley economy and that of the state of New York. And I wanted to ask, what are the economic expectations for New York State for the end of 2020, maybe 2021? How might the Mid-Hudson Valley differ from New York State, if that's something granular that you can touch upon? And why would it differ? And then in general, which sectors are expected to recover faster, slower, and why?
Sure. So I think the outlook for New York State and the Hudson Valley, it'll depend on the same set of factors that matter for the rest of the country. The path of the virus, the pace and the breadth of reopening, the reinfection rates that result from reopening, and ultimately, progress towards establishing a vaccine or effective treatment. And of course, I'm not an expert on any of those factors, so we're just left with scenarios. And all I would predict is that uncertainty is going to remain the highest in living memory. What we know for sure is that 15 million workers have lost their jobs since February. We know the unemployment rate is the highest of our lifetime, and we know the hardest hit have been the most vulnerable, with the heaviest job losses, for example, coming from communities of color, women, and lower wage workers. So as you've heard President Williams say, we know what we have to do, which is to deploy all of our tools forcefully and aggressively to get the recovery underway and to prevent needless bankruptcies and prevent long-term separations from the labor force. With respect to the Hudson Valley, Jonathan, I'll just mention a couple of upside risks and maybe a couple of downside risks that distinguish it. On the upside, many people have shifted their de facto primary residence from New York City to this region, to the Hudson Valley region. And this could be, it's too early to say, but this could be a part of a broader shift away from densely populated cities. To the extent that's a real trend and to the extent that it persists, there ought to be some positive effect on a number of services industries in the Hudson Valley. So you could think of food, medical care, home maintenance, landscaping. There could also be more business relocations to the region, but we don't have clear evidence of that yet. Another another source of insulation, I would say, for the Hudson Valley region is the tech cluster in Dutchess and Ulster counties. Tech has generally done well through this episode. That ought to be a bright spot. I'll just mention a couple areas of concern as well. And these concerns apply not only for the Hudson Valley, but really across the state and the country. And first is the outlook for college towns. So as you know, New Paltz and Poughkeepsie have already been hit quite hard. That may continue in the coming academic year, depending on the reopening plans for SUNY, Vassar, Marist. The second is tourism, which is taking a hit, will likely continue to take a hit in an environment of caution.
It's interesting. The move to the Hudson Valley, it's already beyond anecdotal. Our biggest issue is going to probably be the lack of supply of houses. This is, at least in my estimation, very different than after 9/11. There is 9/11 was driven by fear. This is partially driven by fear, but there's this other aspect to it which allows us to think about moving someplace because we now know we can work remotely. And for those people that love commuting, I don't know any, but if they didn't have to commute. So there's a lot of settling out, which could lead to an increased educated workforce in the Hudson Valley, I think. And, I'd like to seize upon that as a positive for the Hudson Valley. It's not going to overwhelm us. New York City will continue to be New York City, but a couple of thousand people here or there could be the difference in new taxpayers, for the Hudson Valley. Joe?
Sure. So, Daleep, earlier in your remarks and presentation, you mentioned that the Fed has tried to adjust the lending facilities to make them more inclusive. And I was wondering if you can talk to us about the decision process in making those changes. How does the Fed take in and evaluate feedback from communities like the ones we serve? Last summer, President Williams came up and heard from our community. So I'd like your reaction to that.
Yeah, sure. So first, in terms of process, when the Fed Board of Governors proposes a facility and it's approved by the Treasury Secretary, the first thing we do is we put out a term sheet on our website and an FAQ that explains how does the facility work, who's eligible, what are the borrowing terms, for how long can you borrow, what's the borrowing rate, and what are the conditions of using the facility. And then we begin to take in a lot of feedback from the public. We do that through dialogues like this one, through hundreds of comment letters from Congress as well. We get a robust channel of feedback and so forth. And then we adjust. You'll notice that every term sheet for every facility has been updated since it was initially posted on our website. And I would say that in every instance, these adjustments have been meant to broaden access to the facilities and to broaden their impact to more segments of society. So the municipal liquidity facility, for example, broadened the program's eligibility so that smaller cities and counties could qualify. And that expanded the eligible set of borrowers from around 75 in the original terms to about 400 now. The same thing is true of the Main Street facility. You've seen a reduction in the minimum loan size. Originally, it was 1 million. Now it's 250,000. We've made nonprofits eligible. The borrowing term for Main Street has been extended, and the repayment deferrals have become more generous. So those are all adjustments in the right direction. But in addition to who's eligible to participate, we've also made adjustments to try to attract a more diverse set of vendors and counterparts to help execute the facilities. So given how much pain was being caused by the virus, we tried to get them up and running as fast as possible. That's why we looked to the outside for help to get us to move faster and to give us expertise in areas where we hadn't trafficked before, like corporate bonds. So we brought in outside vendors. They tended to be the larger ones. And now we're looking for ways to include smaller vendors, those owned by minorities, women, and veterans, to help us as service providers for the facilities. That's the right thing to do, and it's important for the public to know we're implementing these facilities not just with speed in mind, but also access and inclusiveness.
Thank you, Drew. Look, I'm going to take the last question. I'm just going to be mindful of our time. So we're now looking at federal deficits of over $1 trillion. Not long ago, deficits were viewed by some as a big problem. Now enormous deficits are, I don't know if the right word is okay, but at least we're tolerating it. Why the change in emphasis, and what happens if interest rates start to go the other way?
Right. So, we don't comment on the specifics of fiscal policy, but I'll just repeat what you've heard from many senior Fed officials, which is that there's a critical role for fiscal policy to play right now. As I mentioned, 15 million workers have lost their jobs since February. The hardest hit have been the most vulnerable. So there's a clear need for fiscal transfers to replace the loss of income and loss of earnings. The Fed's emergency powers, you've heard Chair Powell say, we can lend, we can't spend. We're not authorized to grant money to particular firms or households. We can only make secured loans to solvent entities with the expectation that we'll get repaid. So while we're trying to provide support as broadly as we can, there will be entities that need direct fiscal support. And so the right way to think about what's going on in terms of fiscal policy is it's an investment in our ability to grow and recover. For that to happen, we have to prevent widespread bankruptcies. We have to prevent long-term separations from the workforce, and we've got to restore confidence. That's what will sustain our potential to grow as we were before the shock.
I think we'll end it there. I know we have other questions, and so we may submit them to you in writing and then be able to disseminate the answers to people so they feel as if they had a chance to ask their questions. On behalf of Joe Chaika, myself, the rest of the staff at Pattern for Progress and the Hudson Valley, Daleep, thank you so much, most of all, for your time. We know how precious that is right now, and thank you so much for being with us this morning.
My pleasure, Jonathan.
Thank you, Daleep.
Thank you, Joe.
Be part of the solution. Join. Become a member. Subscribe. Join our mailing list to stay in the know. Attend our events and virtual panel discussions. Sponsor. Become an event sponsor to support our programming. Participate. Get involved in a pattern initiative like Fellows and Lift HV. Invest. Support pattern initiatives you're passionate about through an annual investment. Donate. Make a charitable contribution to support Pattern's work. Connect with us.